Well, the fundamentals are strikingly similar to when you and I did a uranium interview a year ago, which is to say that there had been an overhang in the physical market as a consequence of the shutdown of the Japanese reactor fleet and the transferal of Japanese inventory from inventory held as fuel to inventory held for sale. In the face of that, we have a 25 or 30 million pound a year structural production deficit, which is to say worldwide uranium demand increases new mine supply and recycled supply by 25 to 30 million pounds a year. The question was always the inventory. I thought that the inventory would likely be addressed eventually by Japanese restarts, or if not, by the growth in the nuclear fleet in places like the UAE or China. Mercifully for the uranium market, Sprott was able to get control of the management contract of Uranium Participation Corp. And change its form of organization from corporation to trust. And I think that really set the uranium market, at least the spot market, on fire. The spot market had been defined by illiquidity, that is to say, very low volumes, and a lack of transparency, opacity. And when Sprott took over and popularized, that product, a scant, 4 weeks ago, that all changed. It's useful for some of your viewers to know that Sprott already has physical trusts listed in Canada, in the United States, that focus on precious metals, gold, silver, platinum, and palladium. And those trusts manage on behalf of over 280,000 investors, about $12 billion. And the popularization of the trust format by Sprott meant that 280,000 investors worldwide started to become familiar with the uranium narrative. The consequence of that is that the spot market went from no bid to well bid. I hadn't understood just how illiquid the spot market in uranium was. A relatively small amount of buying, something in excess of 2 million pounds, as you note, took the market up from $30 a pound to $40 a pound. It may be, I don't know, it may be that what you've seen are the professional trading houses seeing a bid coming in the market and holding volumes off the spot market to see if they can't get 42 or 43. In other words, it may be that supply will come into the spot market sooner than later in response to the investor cash managed by Sprott. We will see that. What I will tell you is this: Sprott is going to make application to list that trust on the New York Stock Exchange, where the overwhelming majority of the volume that they enjoy in their precious metals trusts occurs. If that happens in terms of inflows into the trust, if the material is available to buy in the spot market, quote, you ain't seen nothing yet.
Yeah, well, okay, that is a cause for celebration and possibly for concern, depending on which side of the market you're in. For the utilities, they might be concerned about complete lack of inventory. Do you see that? Do you see that happening?
I think that the utilities will be able to contract long-term for inventories. The market isn't undersupplied at $60 or $70 a pound. The market is undersupplied at $40 a pound. Remember that fully loaded, including the cost of capital, not just mine op cost, but cost of capital, the incentive price for uranium is between, sort of 55 and 65 US dollars a pound. Let's call it 60. Is there adequate supply at 40? No. Is there adequate supply at 70? Yes. Cameco, as an example, has said that they won't restart their shuttered production until they lock in enough volume in long-term contracts that will allow them to make a reasonable return on capital employed. So for the utilities, ample material exists at prices that allow the industry to be profitable.
Right. Well, let's talk about the price first, and then we can talk more about the trust. $40 a pound, is that high enough for miners in North America, at least, to restart their operations in mining?
You probably could restart Cigar, although I don't think that you will see Cigar restarted at 40. For most of the production in North America, while $40 may cover mine site cash costs, it does nothing in terms of incenting new production, and it doesn't earn back the cost of capital. North America, with the exception of the Athabasca Basin, is not a low-cost environment. And the Athabasca Basin is, in fact, a high CapEx destination. To incent new production in the Athabasca Basin, I think you're going to require at least $60.
I like to make an analogy to gold now, Rick, and I'd like you to correct me if you think I'm completely off base here. So we know that the all-in sustaining costs for most of the large senior producers are somewhere around $1,000 to $1,200, depending on who you're speaking with, maybe sometimes lower as well. But let's just give an average of $1,100 an ounce. Now, what you're saying for uranium is this is essentially the equivalent of saying we're currently at $900 an ounce for gold, in terms of how cheap it is right now.
I would argue something else, too, that's a little more nuanced, which is to say that all-in sustaining costs doesn't take into account prior year write-downs, which in both the gold and the uranium market have been very high. It doesn't show up on the balance sheet, but it does speak to the investor's cost to develop a pound of production or an ounce of production. More importantly, it doesn't call into account the cost of capital. All-in sustaining costs is an artificial number. It's bad. It's not as bad as the numbers that used to be bandied about, but all-in sustaining cost does not take into account the total cost of production, including the generalized, non-specific general and administrative expense, but more importantly, the cost of capital. And companies don't exist without a cost of capital. So I would argue that the AISC that you see in the uranium space and the gold space is artificially low. It doesn't go to things like opportunity cost.
Okay, but the parallel I was drawing was that uranium is severely cheap, even taking into account your point about the all-in sustaining cost being underreported. Would that be a fair assumption to make right now, that even at $40 an ounce, a pound rather, even at $40 a pound, even after a 33% spike in a matter of weeks, we're still severely undervalued?
Absolutely. I would suggest that the only producer that has long-term solvency at US $40 a pound is the big Kazakh producer, Kazatomprom.
Okay. Can you share maybe just a little bit more information about the Sprott Uranium Trust, from the idea of the inception to the launch? Why now, basically? Why this year?
Well, we've been trying to get control. I say we. I'm not an employee of Sprott anymore, although I'm a large shareholder and director. Sprott has been trying to get control of the management contract there for 3 years. So the best answer to why now is because we were able. The arithmetic around the uranium market has existed virtually unchanged for 3 years, although the supply deficit ate away at the above ground inventory. So our timing was probably particularly propitious. But the truth is that Sprott has existed as a contrarian investor in natural resources through its whole time on Earth. You'll note that our gold and silver trusts were very, very, very active during the bear market for gold and silver. And despite those bear markets, we built up large assets under management. So the sort of contrarian sense of natural resource investing is baked into Sprott's DNA. Well, we'd like to take credit for brilliance, which is to say, timing our entry into the market perfectly with regards to tightness in the spot market. That didn't occur. It was really a consequence of being able to arrive at a transaction that suited all parties.